This is Financially Fit Business with Ruth King.
Welcome to the Financially Fit Business Podcast. Here you discover ideas, tactics, news, and information that matters to the health of your business or your clients' businesses. I'm your host, Ruth King. Here's how we will help you increase the financial fitness of your business today. Subtle changes in P&L and balance sheet trends mean a lot. It's best to pay attention to these small changes and resolve them before they become major cash flow, productivity, or profitability problems. In the last episodes, I covered little changes in the overall profit and loss trends, changes in gross margins, and changes in productivity. In this episode, I turn to balance sheet changes, starting with the current ratio and the asset test. Let's get started. Current ratio and asset test are two of the three liquidity ratios. The third is accounts receivable to accounts payable. That one is kind of crazy, so I'm going to leave that one by itself, and let's talk about the current ratio and the asset test, also known as the quick ratio. Remember that current ratio is current assets divided by current liabilities, things that are current assets, i.e. cash, accounts receivable, inventory, prepaid expenses, and for construction, sometimes we have overbilling and underbilling and those things. I'm not talking about those right now. And current liabilities are things that have to be paid within a year. Current assets are things that are cash or turned into cash within a year. And it's the division of the two. In the asset test, for those companies who have inventory, it's current assets minus inventory divided by current liabilities. For companies that don't have inventory, the current ratio and the asset test are identical. So depending upon whether your clients have inventory or not, you may or may not do an asset test ratio. So when we look at this ratio on a monthly basis, again, monthly can be going up and down and up and down, like a yo-yo, like a EKG or an EG or something along those lines. But you need to make sure that it should stay within a specific range, hopefully an increasing range, because obviously increasing current ratio generally means increasing profitability and increasing ability to pay your bills. And generally the business is in better financial health. The current ratio should never, ever, ever be less than 1, because that means you have more current liabilities. The company has more current liabilities than it has current assets. Not a good place to be. The only way out of that is with profitable sales. That's it. Now, yes, some rich uncle can loan the company money, but if the company doesn't fix the underlying problem, then that money will just all go to waste. All right. Fix the underlying problem, which is generally profitability. So when a company sees decreasing current ratio in a month, check the P&L and see whether the month was less profitable the month before or was an unprofitable month. I mean, in some seasonal businesses, there are profitable months and there are unprofitable months. So if you see the current ratio going up and down and the asset test going up and down, look and see what the profitability was for those particular months. And in months that are profitable or more profitable, the current ratio will be going up, right? The other thing you want to look for on a monthly basis is that the current ratio and the asset test are parallel. So if the current ratio is going up, the asset test should be going up at the same parallel to the current ratio. Current ratio is going down, asset test should be going down the same way. They should be parallel lines going up and down and up and down and up and down and up and down. And if they're not, and if the current ratio spread and the asset test spread are increasing, then the company is building up inventory. And that is one of the questions that you have to find out the answer to. Why? All right. Now, was it a situation where they just didn't put it on the P&L and they used inventory as material expense, and for whatever reason it didn't get put on the P&L? Could be. And if that's the case, then the gross margin should be higher that particular month. So as you're seeing all of these ratios kind of go along with each other, if one is saying one thing, it should be corroborated with another ratio. So looking at it from a perspective of current ratio going up, but asset test not going up as much, it is a material expense or materials issue. It is an inventory issue. Make sure that the company is not building up inventory. And, and maybe it is. Maybe it was a situation where you had a supplier give you a deal that you couldn't refuse on materials. And in those particular cases, of course, you're going to buy it. So inventory went up. Guess what? Your asset test at that particular point is going to go down. So if there is spreads between the current ratio and the asset test, they should be explainable. If they're not, your client or as the business owner should be looking to figure out what's going on with inventory, or somebody's unfortunately stealing it, which is not the fun thing to do. But I have seen that happen also. So monthly tells the immediate story, and up and down, up and down, up and down. Preferably you're going up. The ratios are going up because it's easier to pay bills. The company's becoming more profitable. The two lines are staying parallel. So the gross margin should be, let's put it this way, the gross margin should be okay, assuming it's not a labor issue with respect to gross margin going down or up. Okay, let's leave it that way. But that's really what is important with respect to the monthly data. And once we look at the monthly data, again, there may be slower times and busier times. Profitability goes down potentially in slower times. You should see that and a year over year basis with what happens on the monthly basis. And I see this a lot, year end. Things happen, adjusting entries get made, all the fun things, profitability goes down, asset test goes down, current ratio goes down, and then everything is back up to normal in the following January. So if we're looking year over year, we can see what the trends are in, whatever the fiscal year end is. And, with a lot of companies, it's December. So I see December's numbers, both from a P&L perspective and a current ratio perspective, go down simply because of all the year-end adjustments that get made. Okay, when we get back from break, I will go through the trailing data as it relates to current ratio and asset test. Thanks for listening to the Financially Fit Business Podcast. We'll be right back.
Financial advisory services are the key to the longevity of the accounting profession. If you want to get started providing advisory services, or want a review of a finance course you took in college, Ruth King's manual, Understanding Financial Trends Analysis, might be your first step. This manual gives you the information you need to help your clients with their financial statements. A great start or addition to your financial advisory practice. You help them with clarity on their business's financial health, the ability to spot impending issues and resolve them before they become a major crisis. Less stress and sleepless nights, worrying about the financial part of their business. Your Financial Statement Trends Analysis Manual is the reference guide. What do you want in your financial advisory services practice? Click on the link below for more information and to order.
We're back. Thanks for listening to the Financially Fit Business Podcast. Before the break, we talked about the monthly data as it relates to current ratio and asset test. And remember that these two ratios, as they are increasing, means that the company, as a general rule, is more profitable. It's easier for the company to pay its bills most of the time. If the company, for example, bought a truck and they were trading current assets, i.e. cash, for long-term assets, i.e. fixed asset, the truck, then our current ratio is going to go down because our current liabilities are going to be the same thing. So if we see a lot of truck buying and things along the lines like that, it's not an operational issue. Current ratio is going down not because of losses, but because of buying assets. Likewise, if the company pays a huge tax bill, same thing, that goes there. I've also seen companies get retainage on the flip side and pay off all their bills because we don't include retainage, and we'll get to that when we talk about receivables to payables in that particular ratio, because you never know when you're going to get it. So, I mean, there are reasons that way that the current ratio might go up or might go down. I mean, PPP loans were a perfect example of it. The companies got money in the door. It was a long-term liability until it was actually forgiven. And so the current ratio went way up as a result of that. So look at it most of the time. Increasing current ratio on a monthly and trailing basis means increasing profitability and increased ability to pay your bills most of the time. Okay. All right. So let's get into the trailing trailing current ratio and asset test ratios. If they are going down a little bit on a trailing basis, you need to find out why, because that means profitability is probably going down on a trailing basis. And remember that the trailing data and the trailing trends are years worth of data taken a month at a time. So we have totally, taken into account because we have a year's worth of data, those slow months, those busier months, those months where we had different product mixes and everything along those lines. So the trailing data should be telling the company where it's going with respect to the current ratio and the asset test. Now, if the current ratio is going up and the asset test is staying, basically parallel or even going down, I've seen cases like that, it should be a huge warning sign that there are inventory issues. Something is happening with inventory. We had one situation where the company needed an inventory manager because it was just going crazy all over the place. And so the owner hired a inventory guy and basically gave him the keys to the kingdom. The guy could go out and spend whatever he wanted and parts. So he had a candy store. And you should have seen the parts that were brought into that particular business. And the ratio between current ratio and asset test plummeted. It was just insane. You could actually see it. And then as soon as he saw it, it was like, okay, leash is going on. Here are the rules for how you can buy inventory. And it went back to a parallel situation in about 6 months. Remember, it's a year's worth of data taken a month at a time. It's easier to screw it up than it is to put it back together. But they did. And now inventory is managed very, very, very well in that company. And it's been kind of fun to watch. So those are things that you need to look at to make sure if the spread between the two lines is changing. If they're both going down, then the product profitability of the company is going down. And if it's going down just a little bit, a lot of owners don't even see it because all they're doing is they're looking at their P&Ls. They're not looking at their balance sheets. I've seen owners get complacent here where the ratios are going down, and all of a sudden they finally pay attention because they're almost unprofitable. And then at that point wake up. The trend lines will tell you if they will look at them and if you can make sure that you go through them with them every single month. The last thing you want is for a company owner to be falling asleep going, everything's going well, we're really, really profitable, and then have things slip. And I've seen it over and over again because they stop paying attention because they're doing really well and they don't care. And they stop paying attention. It happens more often than you might think. So with little changes in the current ratio and the asset test lines, it's really about productivity and profitability. Are they becoming less productive? Are they becoming less profitable? I'm not saying not productive and not profitable, but are those two trends going down? And that's where you look back on the P&L ratios. And that's why these all kind of mix together to make sure that everything's going in the right direction. So if that's the case, then they have to figure out what's going on and fix it before they do become an unprofitable company. So that's the current ratio and the asset test, two of the most important ratios with respect to the liquidity and profitability of a company. As we go through these episodes, the next episode we'll talk about the accounts receivable to accounts payable ratio. Yes, it's one of the liquidity ratios, but it's so different depending upon what's going on in a company that I like to do that one separately because it doesn't follow all of the same rules as the current ratio and the asset test do. i.e. increasing current ratio means increasing productivity, increasing ability to pay your bills most of the time, unless you got a PPP loan, it's something like that, or paid cash for assets as a general rule, or got a other increase or investment in the company. Increasing is good in this case. Decreasing is, we got to figure out what's going on in this particular case. And if the spread between current ratio and asset tests is increasing, figure out what's going on with inventory and fix it. So thank you for joining us. Choose one thing that you discovered and implement it in your business. These ideas, tactics, and strategies help you make more money, have more free time, and give back. If you like today's program, spread the word. Please review this podcast on any device you're listening to it on. Help a business owner improve the health of his company. For comments or questions, call me at 770-729-8000 or email rking@financiallyfit.business. Thanks for listening. Have a great and profitable day.